Good evening, friends. At the outset, let us first remember our great old friend Harshal, whom we are missing on the annual budget this year. Well, somebody had to take the mantle, and it has now fallen on me. I may or may not be able to do as good or as excellent a presentation as what Harshal used to do, but the finance minister has ensured that all of us are going to have enough work for the future, for not only for the next year, but for the future. And of course, we will have to, after going through the provisions, we'll realize that we have lots of representation to do even before we start the work. So I thank Prabhadevi Study Circle for giving me this opportunity, and let us get into the things, because there are quite a few things we need to discuss. And I'm sure all of you will also have lots of questions and discussions to participate in as we move forward. Let me start with a positive note, first of all, that we are having a bold government ready to take the bull by the horns, as it is said, and would not deter from taking key policy initiatives and not give any knee-jerk reaction. We have 9.5% of the GDP as fiscal deficit for 2021 and likely to have 6.8% deficit in the coming years, increasing our debt bill by about 19 lakh crores in 2021 and about 15 lakh crores in 21-22. Monetization of the infrastructure assets would be the key. We all know lots of things have been announced and proposed. How they unfold, the stock market has already reacted in a very positive manner. How long it will last, we need to see. We see the robust growth in the coming years, and the international confidence on India is ever increasing, and we should seize this opportunity. The government needs to work on the inflation. We still have high food inflation rates, and with increased borrowings, we may have this at risk. Government has renewed focus on capital expenditure, and therefore significant infrastructure creation investment would make things better in the long term. My age-old adage, which continues, and the finance minister as well as the CBDT has ensured that it continues. I am the country's draftsman. I draft the country's laws. For most of the litigation, I am the cause. This we shall see right through each clause that we are doing, and how we already had a very detailed session today morning in the Bombay Chamber, where most of the participants participated in a very active manner and were keen to put up the representation on each of the clauses that we are going to discuss, and how they are going to benefit us, not benefit us, either by increasing our compliance and professional practice, or sometimes in the tax arena. But on the whole, according to me, the tax burden is going to increase, because the tax rates have not been changed, no doubt. But due to changes in the withdrawing, amending, or altering other provisions, the income chargeable to tax has increased, and therefore applying the current rates as they are to the enhanced income will increase the tax outgo. This will result in a higher effective tax rate. The corporates normally are used to reporting to the board what is the effective tax rate and how efficiently we have managed the tax portfolio for the company. And therefore, effective tax rate is a concept which is looked at by most of the board members, managements, owners. And if we have to show our performance, that is one of the ways in which we show the performance, that this year's effective tax rate is lower than last year's, or the other way around. Optional tax regimes for individuals and corporates already withdrew the exemptions, reliefs, and deductions, and thereby arrived at the optimal tax rates. As far as rates to be announced by the finance minister are concerned, they are now optimal. We had 30% tax rate, from where we came to, there was an option for corporates to come to 25, then to 22, now to 15. MAT has gone for all those new options that are being exercised, but various deductions, exemptions are also being withdrawn. Therefore, the increased scope of compliance on all fronts, it does not augur well with the concept of ease of doing business, but it is causing the disease of doing business. This is the new phrase I have learned from some of the discussions I had with many chartered accountants, and they said whether this is going to increase the ease of doing business or will it cause the disease of doing business. Let us see. Football is a game where we all know that goals have to be scored. The standard size of the football goalposts is something I have tried to depict over here. What the department, by keeping the tax rates constant, what they have decided to do is to change the goalpost itself. We are having an increased goalpost, and therefore the same tax target that is there is going to be going through that goalpost, which is much wider now and much taller now. Why do I say so? Because there have been provisions that is says whatever was exempt earlier is not necessarily all exempt now. It will be exempt to the extent they wanted to keep it. Many of the High Court decisions, Supreme Court decisions have been overruled to encompass more items into the tax net, that is the taxable income net. And accordingly, the goal will be scored easier by the income tax department when the goalpost itself has changed. So this finance bill is not in keeping with the ease of doing business, but telling the resident SSE, particularly the resident SSE, that he is suffering from the disease of doing business. Because lots of reliefs have been given to non-residents and many options for foreign investment to come in. But as far as residents are concerned, many harsh provisions which we shall see. As an overview, I've tried to list out most of the things that I'll be discussing. Some of them I may discuss a little more in detail. Some may not be in as much in detail because having gone through the provisions time and again, being part of discussions at various forums, I have found that some specific provisions require a little more explanation, understanding, and what exactly seems to be the intent. What do the notes on clauses say? What do the explanatory memorandums say? And finally, what has actually come out. How it will finally manifest in the actual practice will have to be seen. And there might be discussions on some of them. So I will be discussing the LTC scheme, the Leave Travel Concession Scheme, which was announced way back on 12th of October 2020. But the announcement came in the form of a press release, and it was only announcing for government employees. It did not specifically say, though it did mention that non-government employees, the law would be amended and would be given the same benefits, that instead of whatever you're entitled to, because as it is, travel has been restricted because of COVID. So whatever financial support you were getting as leave travel concession or leave travel allowance, that may be used for purchasing some white collar goods. The rules therefore were mentioned in the press release, but only for government employees. Many corporate SSEs, especially in our group, where they were insisting that we can go ahead with announcing a scheme for our employees. But I said, where are the rules? Where are the amendments? And until they are in place, they cannot. I would not suggest that we go ahead. Now they have come. You can see it in black and white, and which is very much on the same lines as what the press release for the government employees was. However, the time for the private sector or the other employees has been much reduced. So it comes down from 1st February to 31st March. And actually, by the time this becomes an act, perhaps it will be even shorter if you are going to take a conservative view of being very careful that only after the law is amended, we put it in place. But that is one possible option that you have. But now that LTC scheme has come in, though I would not call it an exceptionally high scheme or something that is really going to boost up consumption to a great extent, but all the same, it is some benefit to employees who are going to get a little lower rate of tax in their final annual outflow. But the other provision that has undergone change is notified overseas retirement funds. We all know that there have been retirement funds that have been participated in by employees who are employed abroad. When they were abroad, they were governed by the tax laws of their respective jurisdictions where they stayed. But some of them could not move, and then the retirement has come through. And if they have come here, where it should be taxed, relief under Section 89A has been provided so that the resident Indians who finally come back and become resident, those who are non-resident and at that time had those benefits, they can get a tax benefit of the investment of retired funds that they have invested while they were active or when they were non-residents. Section 10D, 1010D, which is in respect of exemptions of insurance proceeds. There was a lot of hue and cry of ULIP in particular, unit-linked insurance plans, which were not finding favor or which were getting exemptions under 1010D. Now there is a restriction put so that if the insurance premium component of a unit plan that has been participated in, if that is a total of 2,50,000 rupees in a year after the new date clicks in, then it is going to be exempted. It will not be exempted under Section 1010D. This is for investments made after 1st February 21. The old ULIPs will continue to enjoy the benefit. There are as many as 4 clauses that have been included, provisions that have been added to 1010D for the ULIP restriction, which we shall see in detail. Another area of Provident Fund, which has caused the Income Tax Department a lot of heartburn. We all know that there is already Section 1012, which provides for exemption of the interest earned on Provident Fund investments. Now, this section talks about investment, the exemption being provided to an employee. It does not talk about an exemption to be provided to an SSE. Now, this word employee has been interpreted by various tribunals to state that once an employee superannuates or retires or leaves the employment, he does not remain an employee, and therefore any accumulation of interest on the such provident funds is going to be taxable in his hands. Now that the government seemed to be not sufficiently or happy with, and there was also the option. Normally, you have provident fund as 12% of the basic pay being contributed by the employer as well as by the employee, and that accumulation on retirement would be available along with the interest for the lump sum enjoyment of tax-free corpus, actually, as we call, to the employee. At the same time, we had the concept of public provident fund, which the proceeds of which have been the interest of which is exempted under Section 1011. Now, there is one commonly worded explanation that has been added to both Section 1011 as well as Section 1012, which we shall examine in detail. Lots of controversy is already there, whether it's a total amount of 2,50,000, whether the interest thereon has to be considered separately for PPF and separately for Employee Provident Fund, or both have to be clubbed together. That controversy will rage on. But since as it is the exemption was in 2 different clauses and both have been inserted with an explanation, we'll have to look at it independently. And you perhaps PPF may not be so much affected because there is an inbuilt limit of the investment of PPF to the extent of 1,50,000. This is not anything to do with Section 80C. 80C is the limit for granting a deduction. As far as PPF scheme itself goes, the maximum amount that can be invested is 1,50,000, whether in your own name or in your minor child's name or in your spouse's name. Anywhere, finally, the limit of 1,50,000 is there. Declarations are taken at the time of opening of the account that there is no other account that is there in which the investment will be made. And if at all it is made, then all put together, only 1,50,000 is entitled to interest. Monitoring of the same in different banks and different branches is a challenge by itself. How well people manage it is a different issue. But now new restriction has come, that if the investment in provident funds exceeds rupees 2,50,000 by the SSE or the employee, then the interest thereon will enjoy exemption under Section 1011 or 1012 only to the extent of the investment being up to 2,50,000. All the excess amount will be charged to tax. How the rules will be framed has yet to be notified, which we will see. The wordings are so badly mentioned in the explanation that it has caused enough confusion and debates, and there is going to be a lot of representation as to what should be the common wording and how it should be worded so that there is no confusion. and all the highly paid employees who are getting huge benefits. So 12% is the basic amount that is invested. Over and above 12%, normally it is understood, up to 88% of the basic pay can be invested as voluntary provident fund. That is sought to be plugged. No doubt, employees like me have taken a benefit thereof, and perhaps to some extent, as somebody put it today morning, you are the culprit who has caused this to happen. Even if I am a culprit, no doubt about it, I have got my tax-free corpus. Now, henceforth, whatever investments are made will have to be restricted. That is what is going to be seen. Senior citizen benefit. We already had two categories of senior citizen. One was above the age of 60, and the next was super senior citizens above the age of 80. Now, the government has thought it right to create one more class, that is above the age of 75. Now, if such SSEs who are above the age of 75 and they have got income only from pension and interest from different types of deposits in banks, and all of it is monitored from the same bank, and in that case, the TDS will be done, computed by the bank itself and paid, and such senior citizens will not be required to file the income tax returns. We shall examine a little more in detail when we come to that provision. At the same time, I think there are going to be literally handful of cases which the government will actually find who can get themselves categorized as such senior citizens, and they can get the benefit thereof. The hue and cry made is so huge that senior citizens are being given benefit of exemption of filing returns as if it was some huge bounty that is thrown upon us. But if you look at the conditions, you will realize that there are going to be numbers of perhaps single-digit number of SSEs who will get this benefit, if at all. Pre-filled ITR forms. We all know that our AIR, KYC norms, Aadhaar card linkage, PAN card linkage to all our investments, and the manner in which all banks, transfer agents, everybody is required, and wherever the investments are made, mutual funds, all are required to file the AIRs, annual information reports, and the income tax department has complete record of all the financial transactions being carried out by those who have PAN numbers. Now, this is going to be collated, and PAN-wise ledgerizing or sorting of the data is going to be done. And as far as capital gains is concerned, salary and TDS is concerned, these will be auto-populated in the ITR forms that will be available. As it is, we know they are assessment year-based forms. The information that is collated would be analyzed, and the information will be given. When you try to upload your return, you will get a pre-filled ITR form. Of course, businesses are run independently, and therefore businesses may not face the same benefit as yet. All the same, as far as capital gains, salary and interest is concerned, there will be pre-filled ITR forms. The question definitely arises, how capital gains for listed securities also will be populated by this department is a question. They would get the sale proceeds, the details of the sale transactions. But as far as acquisition, which year it would have been done in, what will be the, if at all, indexation is applicable in those years, if not applicable also, whether only demat transactions would be considered, what about the period when they were in physical form and then they were dematted, all those questions would still arise, and the costs, how they would be allocated, determined, and capital gains arrived at, has to be seen as to finally what is the outcome and how it has been, how it will be actually translated into action when the ITR form reaches us. That needs to be seen and only then tested. It was very nice to hear it in the finance minister's speech that lots of work is going to be done by the department, but frankly speaking, who has done it? The data entry has been done by those who have filed the AIR forms, by those who have filed the TDS returns, that is finally you and me. All the data entry operation has already been transferred to us. We are doing that whole exercise and giving it, for which we are neither remunerated, but we are only faced with short deduction notices, interest, penalty, prosecution, and disallowance, and the harassment of the auditors. We ourselves as auditors are causing lots of harassment to the SSEs when we are qualifying their TDS aspect. Clause 21 and clause 34 of the tax audit report is always a bone of contention between an SSE and an auditor. So this we all know is going to be the basis on which these pre-filled ITR forms are going to be released. How they will finally come, we'll really have to wait and watch. The pet subject that I have, TDS, there are as many as 9 sections that have been amended. The scope of work has increased. In the 9 sections, there are 4 new sections that have been introduced and 5 sections which are modified to give effect to that enhanced scope of work that all of us have in the area of TDS. We will discuss this a little more in detail, and I will also share with you what we had given as a pre-budget memorandum, what we will be again reiterating to the department as to how TDS area can be made more likable, enjoyable, beneficial for both the SSEs, the chartered accountants, and the department itself. Right? We have a proposal. Let us hope it is accepted, and how it carried forward, we will see. Disallowance in respect of Employees Provident Fund. We know Provident Fund, again, we have again to talk about it. We talked about it twice earlier. We talk about it now again. As employers, there is both the employer's contribution and the employee's contribution. 43B talks about the employer's contribution. It has to be paid in time. Section 2 already talked about the collection made from the employees of their provident fund is treated as your income of the deductor, and if that is paid in time within the specified time limits, then it would be allowed as a deduction. So far, there was a concept that if there is a delay, only the employer's contribution should be attracted, employee's contribution should not be attracted or faced with a disallowance. Now, 43B also has been amended, 36(1)(5)(a) has been amended, section 224 already includes that as an income. All of them read together. Now it says, irrespective of whether it's employee's contribution or employer's contribution, if there is a delay in depositing the same to the government, there it would be disallowed as an expenditure. It will not be allowed at any future date. Now this, I feel, is a very harsh provision, and whether income tax law is the right place or the right platform for punishing those employers who, for even genuine reasons, have to delay the deposit of the provident fund to the income tax department. The concept of unjust enrichment is sought to be addressed with this provision, but making it absolutely harsh that 1 day's delay also for a reasonable cause will not entitle you to the allowance of that expenditure for time immemorial. To what extent that is a justified and understandable or rational approach is a question to be fought out in the courts if necessary. But right now it has been proposed to be made the law, and we should protest against it and ensure that this sort of, especially where there are reasonable circumstances, if there's a fire in the place on the day it was due, and there is more loss than only the money that was to be deposited, just imagine if whether or not such reasonable causes should be considered as good enough for a delay, and therefore should not be faced with harsh provisions of disallowance. So a genuine business expenditure, a genuine outflow of money, if otherwise would have been allowed had it been paid in time, will not be allowed under these provisions that needs to be reviewed. Slum sale, it came on the statute book under section 50B from 1st April 2000. Today, now we want to look at it in a different manner, though the definition was on the statute book even before. But the charging section for a slum sale and the long-term or the short-term part of it was brought by section 50B only from 1/4/2000. Now, those definitions of slum sale itself and what all it entails is going to undergo a change, particularly for public sector undertakings to be brought within the purview of slum sale, because undertaking, as we understood under section 219AA, was what was getting the benefit of a slum sale. If I sold the undertaking for all the assets and liabilities attached to that undertaking for a lump sum consideration without assigning values to each of the items contained therein, that would be contained as a slum sale. Now, this would normally be available for an industrial undertaking as it was understood. interpretations, judgments finally came about that no, it can extend to other than industrial undertakings. And now what is sought to be brought in is that for other concerns and particularly government undertakings, public sector undertakings, also the definition of slum sale and assets would be inclusive and they would be permitted to go in for slum sale. 45.4, one important section which has been on the statute book, used, interpreted, decided upon in various levels right up to the Supreme Court, now has been revisited because allegedly it has been used and misused by many partners in tax planning, and the tax on the transfer of assets, on the retirement of or reconstruction or dissolution of a partner of the firm, how it should be taxed and how it should be treated. A detailed new code practically has been brought in, and we need to look at those provisions in detail. Of course, this time today I will not be going into enough depth on this because I think it requires a separate session altogether. We are already in the mode of preparing detailed different case studies only to understand what is the implication of how 45.4 and 4A will finally be practiced and how we should advise and plan our affairs in a manner that the benefit sought to be taken will continue for partners or it may end up in taxation of the firm and therefore an outgo of such a manner that it was not perceived earlier. And now we need to re-look at the newly worded sections as they are in 45.4 and 45.4A. A very, very harsh hitting provision on goodwill. Goodwill per se, though an intangible asset, was definitely a part of the definition of goodwill, though not with the same wordings, but as business rights. Transactions of mergers, demergers were taking place, and whatever assets, even whether in a slum sale or a merger, demerger, or an amalgamation that was happening, the difference between the value, book value of assets that are transferred and the consideration for the entire transfer, whether by way of slum sale or demerger or amalgamation, that difference was treated as goodwill. The same was categorized as intangible asset, and so far we did not have any difficulty. And for that matter, we had a Supreme Court decision in the case of Smith Securities, where it said that such goodwill would be entitled to depreciation under the class of intangible assets at the rate of 25%. And there were many, many transactions which actually took place on this basis. But this definition, as well as depreciation, both are sought to be amended from 1/4/2020, effectively for assessment year 21-22. So transactions which have already happened, for which advance tax has already been paid for 3 quarters, June and September and December, now will be revisited with a higher tax element. The goalpost has been changed. I'm going back to something I started off with. The goalpost has been changed, and the tax department will be able to easily score the goal and say that you have paid less advance tax on the goodwill depreciation if you are claiming it, or whatever otherwise benefit was there in the transfer of the assets as well as goodwill. All those transactions will be looked at with a different lens. That goalpost will have to be revisited, and the tax liability has, in spite of the fact that the rates of taxes have not been changed, the rates of the tax liability has not been changed. International financial services centers, a concept which was already brought on the statute book to give further incentives and invite foreign investments. Again, a set of sections, as many as 9 sections, to undergo a change, which I will not discuss in detail today. I've listed them in my presentation. I'm drawing their attention, but we will need to have a separate session, and that would depend on how many of us are really practicing, advising, auditing, carrying out the activities of IFSCs. We will go into those details, but there are as many as 9 sections that are amended and far-reaching at that. It will have to be kept in mind after this finance bill becomes an act, especially if they are not modified by the time it becomes an act. In that case, we have to study those provisions in far more detail. Startups, we know, has been an important bane, and this particular government has tried to encourage as many startups as possible. The provision was there already in Section 80 IBA, and it has sought to be, it was having a sunset clause. That sunset clause is going to be extended by 1 more year, no doubt. Because of COVID, many startups also had to slow down their activity and to see that the benefit that has been provided to startups, if it has got to see the light of the day, it will have to be extended. So out of compulsion in the present circumstances, the government had to increase their sunset date, which is extended to 31st March 22. Affordable housing also was a concept, though with a limited approach of only 45 lakhs. Section 80EA, which was provided for a single house and a limited amount of 45 lakhs invested, and the interest being only up to 1,50,000. That also, the sunset date has been extended, which we shall see in detail. Cooperative banks converting into banking companies. This is another area in which government thought it fit to give them a benefit, and therefore a tax neutral conversion has been proposed in the new section 44 AD, if I'm not mistaken. I will come back to it when we go in detail, has been brought onto the statute. Reopening of assessments. This is one area in which lots of litigation, right up to the Supreme Court, has been taking place, right up to the from the tribunal up to the Supreme Court. Enough number of cases that have been decided in favor, mostly in favor of the SSE. Therefore, they decided to change the entire code of reopening, and a lot of onus that was there on the assessing officer as to why a reopening should be done or not done has tried now to be shifted on to something totally external. It should be only on the basis of information also based on certain provisions and parameters that have been detailed in. And after that, the old concept of not sharing the reasons recorded is being done away with. On the contrary, the assessing officer who has got information on the basis of which he has come to believe that their income has escaped assessment, that is going to undergo a change. That information will be shared with the SSE as to whether this information, if it is acted upon, what will be the type of assessment that will be passed, will be given to the SSE. Then he can give back his feedback as to what his opinion or his approach is towards that particular information, on the basis of which income which was sought to be not taxed earlier is now being brought to the tax net. To that extent, a lot of benefit has going to be provided, but in that entire benefit, the goalpost has been changed from 6 years to 10 years. So a larger time has been granted to the department for, no doubt, cases which are 50 lakhs and above. But in that case, the time limit for maintaining the records and being able to produce them before the department, which was restricted up to 6 years, originally 4 years, then to 6 years, and from 6 years to 10 years and 16 years and above, that whole entire gamut changes, and it has now been extended up to 10 years. So now we shall have to preserve our records without fail up to, according to me, for a period of 10 years minimum. This needs to be kept in mind. Now, because of the information technology, returns no doubt have become supposedly far easier to fill up. We don't need to stand in the long queues at the income tax department to file the paper returns that we used to do. Similarly, assessments also, going to the department, sitting down in front outside the cabin of the assessing officer, and he may call you at whatever time he pleases. There was no standardization of the amount of time that we had to waste in those corridors, which were far from clean. All the same, now those limits themselves, first of all, the faceless and the EAssessments have changed that entire arena. Number one, in a way, very good. But unfortunately, the experience has not been as good as we thought it would be, because no doubt I may not have to meet that person who's going to sit across me who would have a prejudice or a desire to take some gratification from me. That definitely has been done away with. At the same time, what the machine has understood, what the system has understood, whether in terms of the law or in terms of the data, how it is being processed and how it will be rolled out as an assessment order. This time's assessments in March are going to give us lots of flair about what is the machine going to throw out at us. We already had a different era of 143.1 assessments, how the returns filed were being assessed, especially for assessment year 18, 19, 19, 20, and now, of course, 2021. We had a harrowing time. Enough rectifications had to be filed. Sometimes we had also to file the appeals so that in case the rectification is not carried out, then at least our appeal would give us the relief. But yes, to that extent, I would have to say one thing. We have had a good experience on the 154 applications that have been filed for those e-assessments done under 143.1 and some adjustments being made because the manner in which filing of returns takes place, what the department has in its mind as to which column should represent what item and how much it gets translated to the people who are actually filing the returns, who are feeding the data entry into the return portals, e-filing portals. That mismatch has caused a lot of trouble for a lot of people. However, the manner and the time limit within which this whole exercise is taking place and the speed with which the department is able to process the returns, they feel that a much lower time for assessment as well as filing is required. And therefore, the provisions in relation to 139, 139.4, 139.5, 143.1, 143.3, all of them have undergone a change. Only the reassessment time has been extended. All the other assessment times have been reduced. To that extent, whether it is a rational move or not, only time will tell and we will have to fix it. The experience with e-assessments, e-appeals, and the virtual hearings that we have had at the tribunal has been so good that a faceless IT scheme is sought to be promulgated by this provisions in the Finance Act. But I am not too sure whether that last fact-finding authority, whether having it in a faceless form, not giving an opportunity for video conferencing, or providing those opportunities only in a restricted manner, to what extent it will work out as a beneficial scheme, only after the details come and we test and we taste that pudding, we will know whether it is a fruitful scheme or not. At the same time, in the present era, the manner in which things are going, I think it is a welcome move, provided network issues and technical issues don't cause problems with the SSEs and how their cases have been represented. So much of testing has to be done. Let us see how it happens. Dispute resolution for smaller SSEs, a very welcome change again. However, the experience with dispute resolution panel for transfer pricing cases that has already been in place for now almost 14 years has not been so good as to say that yes, we are all fit for the dispute resolution to take place in a manner that everybody will be treated fairly and there will be less dealing across the table and facing specific commissioners. How it will be has to be seen. A collegium of commissioners, and especially for the small SSEs of those who have declared income up to 50 crores and having disputes only up to 10 crores, they are going to be benefited by the dispute resolution panel that will be constituted for them. I hope it works out in a better manner and they are not given the restriction of only confirming what the assessing officer has already done, which has been the experience with the dispute resolution panel. At the same time, the new provisions for settlement commission from 1/4/2021, from 1st February 2021, the dispute with the settlement commission comes to an end. There will be an interim settlement commission for whatever is there in the pipeline to complete that job, but at the same time, otherwise, the concept of settlement commission, the results of the settlement commission, and the concept of faceless assessments and faceless appeals will bring an end to the Settlement Commission. Notwithstanding the corruption therein, which is not a part of our discussion, but on the whole, the faceless assessment comes to an end. The Settlement Commission comes to an end. This is what we understand. So if there are any pending matters, then within the next 3 months, they'll have to be sorted out and completed. And accordingly, those who are involved in that practice or who have pending matters, please approach it in that manner. Tax audit limits. We saw that the compliance burden has been increased to a great extent. And the effect of that, whether in section 40A1A, whether in section 43B, whether in terms of compliance and the interest and the higher tax to be deducted, all those provisions, whether they are actually complied with or not, could have been properly monitored in the tax audit limits. But looking at the scale and the manner in which we are growing, it was considered better to concentrate more on the larger SSCs than the small SSCs. No doubt, many chartered accountants will be badly affected as far as their practice, if they are concentrating only on tax audits, will reduce. But all the other compliance provisions that we shall see in detail will increase the compliance burden, and therefore practice, as I say normally, does not actually get reduced over a period of time. We have seen prior to 1989, where even advance tax statements had to be filed in physical form, Form 28A and Form 29. Even the applications for extension of time for filing a return had to be filed in person. All those cases when the shortfall and excess of advance tax was again levied with interest, penalty, and their respective appeals, all that work had reduced a lot in 89-90 and onwards. We thought lots of activity is going to reduce. Did it reduce? Tax audit provisions themselves underwent a change. We saw the increase from 15 clauses to 33 clauses and now to 41 clauses. That has undergone a change. Section 35B, which provided the benefits for weighted deduction for exports, had its own controversies. First of all, planning it, then defending it, then appealing against it, gave many a generation of chartered accountants lots of work for quite a few years. That was replaced with ATHSC, supposed to be a far simpler mechanism of providing benefit under the Income Tax Act to chartered accountants and tax professionals. That again went a change. Same way now tax audit. It has undergone a change. The many audits that were there for various provisions under the Chapter 6A, they got reduced, they got changed. Again, some of them have been modified. They are there. So the reduction in that the number of tax audits perhaps may not cause so much of a havoc as the other provisions are going to cause, where chartered accountants and experts are going to be required to discuss in detail, have their professional expertise provided in detail. This is the overall view that I am sharing with all of you. There are many things in detail which we need to look at and apply our mind as to what representations should be made. Let us discuss those a little more in detail so that a fruitful discussion takes place for actually making the representation, and by the time it becomes an act, as to how it is going to be applied for further assessments, planning, everything that let us look at. We talked about the Leave Travel Concession Cash Scheme. The exemption is provided in section 10(5). We discussed this a little in detail already, but now let us look at the nitty-gritties. The deemed long-term concession, the leave travel concession fare that was being provided in a block of 4 years, that is now provided from the period that is going to be provided for 18 to 21. Instead of 2 times in that period, this will be the third installment that you would be eligible for, and that could be availed of within as a third item. So annually, normally we used to get the fare from the place of residence to any center in India. The minimum fare to that particular place, furthest point perhaps maybe that airfare or train fare, the rules had it all in detail, was allowed as leave travel concession, and you could reduce your tax liability to that extent. This, because travel was restricted, as I said earlier, has sought to be provided that you will get that benefit or up to the extent of 36,000 rupees or one-third of the specified expenditure, whichever is less, shall not be subjected to tax if it is spent on some items which shall be purchased, electronic goods or items, white collar goods that are purchased where the GST payment on such transactions exceeds 12% or more. Such cases will be eligible, and particularly if they are carried out through the electronic mode. Now, all these conditions actually put a now whether it is going to benefit the employees who are getting the benefit or not, or they would rather say that that tax go on 36,000 or one-third of that if they're in the 30% bracket. If that benefit goes, there is no problem, but we might as well use that liquidity for other transactions. And this is going to be available only for the assessment year 21. This is not available for any other year. So once this block up to 31st March 21 goes, then from next year onwards, again that block of 4 years will be there, and twice in a block of 4 years concept will continue. This is how the scheme has finally been rolled out or legislated upon for the employers to give that benefit to the employees. We talked a little about the notified overseas retirement funds. This is inserted to address the issue of mismatch of the year of taxability of the withdrawal from retirement funds by residents who had opened such funds when they were non-resident in India and resident in the foreign countries. At present, the withdrawal from such funds may be taxable only on receipt basis in foreign countries, while it was taxable on accrual basis in India. Now, the new manner and year of taxability to be determined by the central government is to be taxed at the time of withdrawal in the specified country at the time of withdrawal only. So, a cash basis of accounting to that extent will be applicable from assessment year 22-23. There's a typo over there. This is assessment year 22-23 onwards. The new section 89A will come into play. I'm not sure how many of us are going to be directly affected by this, but those who are to advise on non-residents who have been employed abroad and who are coming back and who have come back and who are going to get their benefits, retirement benefits, are going to be affected by this section. 10.10D, we talked about it initially. The exemption for the sum received under life insurance policies where the premium payable does not exceed 10% of the actual sum assured. This is the provision as it stands now. Of course, key man insurance was already excluded even in the earlier provisions. The earlier provision 1, 2, 3 that was there. Key man insurance premium was proceeds were not exempted and they were subjected to tax. However, now we have the exemption to apply in this, not to apply in respect of ULIPs issued on or after 1st February 21, where the premium payable for the year exceeds 2 lakh. Now, the premium payable again is going to be subject matter of lot of difficulties, because when I invest in ULIP, I am investing twofold. One part goes towards the premium and one part goes towards the units which are investments. Now, what part is actually there will have to be quantified, and provision 5 says that if there are more than one ULIPs taken, I may take either more than 2,50,000 or less than 2,50,000. If I am investing into a ULIP plan, so sum total of the premiums involved therein, if it exceeds 2,50,000, there will the benefit of the provisions being exempt when we get back the money will not be available. Of course, this will not apply as per provision 6 that is already there, that in the case of death of the policy holder, no amount will be taxable. And whatever difficulties are there in the above provisions, if they, as I said, bifurcation between what is the proceeds from insurance portion, what is the proceeds towards investment portion. If there are difficulties in analyzing or finding the breakup thereon, this is going to be dealt with, addressed by the board with the approval of the central government, and that will have to be laid on the houses of the parliament. The newer concept that has come, the delegated power to the board, CBDT. Previously, many of them used to be only delegated to the board, but now wherever there is a section on the basis of which a relief is provided, if that is to be modified by the board, now that concept, since last year we are seeing, the board will have to lay those conditions or approvals or benefits that they are granting to the SSEs on the floor of the before both the houses of the parliament, seek the parliament's approval so that it also gets the status of the section being met. This is going to be applicable from 21-22 onwards, which we need to keep in mind. So now, before deciding any further investment in ULIPs, all the insurance agents or the investment agents of mutual funds are going to face a challenge. We will have to see as to what are the approvals granted by the board or the conditions granted by the board, and how the breakup between insurance premium and investment in units is going to be at the time of investment and at the time of maturity. How it is going to be looked at will have to be seen before we can finalize any proposals. Section 10.11 and 10.12 I already discussed a little more in detail, but what is required to be seen are the wordings of the provision that has been added in both section 10 as well as section 11. It says that provided that the provisions of this clause shall not apply to the income by way of interest accrued during the previous year in the account of a person. We are not talking about the SSE. We are talking about the person, to the extent it related to the amount or the aggregate of amounts of contribution made by that person exceeding 2,50,000 rupees in any previous year in that fund on or after 1st April 2021, and computed in such manner as may be prescribed. See, so far we were seeing, even the public provident fund passbook that we have, it did not bifurcate between what investment has been made prior to a particular date, what has been made subsequent to a particular date. Now further, the interest on earnings on such bifurcated investments, how they should be calculated, how they would be looked at, no doubt an arithmetical exercise, but at the same time we have to remember that there is a compounding effect. In the first year you may not face so much of a deal. From 1st April 21 to 31st March 22, whatever has been invested, the interest thereon is fine. But there will be an interest on that interest in the subsequent years. How that will be treated, how that bifurcation should be maintained, how that will be looked at, whether that is sought to be looked at or not, is going to be part of this computed in such manner as may be prescribed. And therefore, a lot of mathematical exercise first for the banks who are maintaining or providing the details, or the funds who are going to take care, the approved gratuity provident funds, recognized provident funds, how they will be providing the data to their employees, cases of transfers. All those factors are going to play their own role, and the complications will be added as circumstances and facts of each case will be unfolded. How it is going to be monitored is going to be a challenge by itself. So we have some professional exercise, as I said, if not a tax audit, perhaps there might be chartered accountants who will get involved in this exercise, or the audits of those, or the softwares relating to those are going to be manned by people who are going to be experts in this field, and we may have to develop expertise in this area also. Exemption for filing returns of SSEs aged 75 years or more. We have already discussed this. Section 194P, which is the tax deduction provision that is going to administer this, has been inserted in Chapter 17B. The bank to deduct the tax on the total income. So bank has got an additional assignment of computing the income of such SSEs, whether by way of pension or interest. The Act is silent about the concept of whether mutual fund investments would be there or not, but the plain reading of the section does not indicate any mutual fund investments. And if the person above 75 years maintains his investment in the same bank, whether that should be considered, not considered, what will be the position has to be seen. And how many such individuals are going to be there is a challenge by itself. But however, the law provides this, and therefore they will not be required to file the return in Section 139. All those who feel that they are going to be benefited by that, may please examine the conditions under which this benefit will be provided to you, or would you prefer to file your return and maintain a clean record thereon? That would have to be decided. Prefilled ITR forms we have already talked about, capital gains of listed securities, AIRs, proof, and if there is an error. I was surprised to find that one of the investments made by me post-retirement, which was done through an electronic mode, I received a feedback saying that my email ID on record is so and so. And that email ID does not contain the @ sign at all. Now, if I have to correct that, if that AIR information, the whatever collated electronic information that is already there, whom do I approach? I don't know. It may be the same investment avenue from where I tried that investment, but the response in which you are getting the electronic data and the manner it is in which it is being thrown at you, how easy it is to correct it, or how easy it is to say that it is correct or not, has to be seen. Any error, whether in terms of your PAN number, in terms of your account number, or in terms of the registered number for that respective investment, or the reporting thereof in the EIR forms, how correct it is going to be a challenge by itself. You will have to see how it is administered and how these pre-filled ITR forms will actually pan out and how all of us are going to face them, and especially the corrections and the exceptions there too, I think is going to be a big challenge. But like TDS, finally that challenge over a period of time will be sorted out after the initial hiccups. If you remember, we had at the time of one of the notices that were raised for the returns filed, the TDS returns filed in 2007, 8, and 8, 9, there were many demands that were raised. And presuming that a demand is going to be forced with enforceability, we started filing appeals within 30 days for most of those cases. Thereafter, it was clarified by TDS itself that in spite of the fact that the demand has been raised, that data is still amenable to correction. They had to put a limit to it of 2 years subsequently. At the same time, it was amenable to corrections, changes, rectifications, and finally, the demand that was raised originally also started getting modified on its own. And finally, those appeals had either to be withdrawn or to be treated as non-est, and no effect was taken by many commissioners on such appeals. There are some appeals which I remember I had filed in those years, which till date have not been heard, and I am not facing any demand collection thereon. And therefore, if those have already been rectified in the TDS realm, similar position may come up in the 143.1 or 143.3 assessments that would be done through the system, through faceless assessment, through electronic media, and therefore even the returns also that will have to be filed. I understand there should be enough mechanism for correction before we file those returns. And I hope it comes through. At least the representation will have to be made. Otherwise, we are in for total havoc and chaos, because we may be faced with pre-filled ITR forms which we may never recognize as to these were our transactions or not. Let us see how it all is panned out. Coming to TDS provisions, the additional responsibility put, and every time I tried to understand and put it into a slide format, I was wondering whether I have understood this provision correctly. I had to have a discussion with as many as 5 chartered accountants to analyze and understand. Yes, I have understood it right, and I'm still open to correction. Let me tell you honestly, I'm still open to correction. What I understand by the new section 206 AB is that the deductor will be required to deduct tax at twice the prescribed rates for the specified sections, or at 5%, whichever is higher, if the resident deductee has not filed his return of the past 2 assessment years and the TDS amount is rupees 50,000 or more. The 50,000 or more definitely reduces the campus, but at the same time, if I have to first see that I have the correct PAN number of all these SSEs whose TDS I'm deducting, otherwise I have to apply 206 AA. That is 20%. Again, for some specified sections, I have to look at not 20% but 5%. At the same time, now to monitor whether after I deduct 2% and I forget it, I report it in the respective sections. In my statement, the 226 AS generated for the deductee, when generate that, you would be very happy. But having generated that 226 AS, if the SSE chooses for the smallness of amount or for any other reason, he is otherwise bedridden, not in a position to file his return, not engage somebody to file his return. He says, let me forego that TDS, and I don't want to file it. In that case, now the responsibility is cast upon the deductor. That if that person has not filed his return, that instead of deducting 2% or 1% as applicable, you are required to deduct 5% as tax deductible source. So that gentleman, that SSE has a PAN number. He has given that PAN number to the deductor. It is a valid PAN number, and yet he is going to be faced with a higher deduction simply because of the fact that he has not filed his return for the earlier. What will happen in such cases where the SSE was so small or he didn't have income at all in the earlier 2 years, and now he becomes an SSE? Whether in such cases any exception is to be provided, we could not find in the provisions as they stand now, and we'll have to do a final reading. At the same time, this additional responsibility on the deductor and the additional cost attached thereto, how it is to be met is a question by itself. And if it was not sufficient that 206 AB was introduced for tax deduction at source, 206 CCA is also sought to be introduced, which is talking about tax collection at source. We all saw last year the provision came that if my turnover exceeded a particular amount and if my transactions for a particular amount, for particular sales were in excess of rupees 50 lakhs annually, then I was required to collect tax at source. Collection of tax at source under 206C1H was provided for last year. Systems were not ready, people were not ready to do it from 1st April. The date got changed to 1st October. Various controversies attached thereto. Large organizations started amending their softwares, accounting softwares, to see to it that the details were rightly captured, the tax collection was rightly done. There was also a clause under 206C1H that tax collection had to be done at the time of receipt of the money. So if I am, for whatever reason I am receiving part of the money, then that had to be looked at. If I am receiving, there are disputes, then that had to be looked at. If there is a sales return, then that had to be looked at. At the same time, while advising our IT departments, that is information technology departments, as to how we have to modify the systems, there was a big challenge. They say you're talking about receipt. At the same time, you have not raised any credit to that SSE. So if it does not enter, you have not raised any debit to that SSE. If it does not enter his ledger, is he likely to pay me? So in that case, whether debit note, credit note subsequently to be issued was a question. So we came out with a solution that we should make it a part of the invoice. In spite of the fact our liability to pay to the government would be at the time of collection of the amount, but until and unless the debtor cannot record that transaction or the liability to pay, would he pay it to the creditor? That would not be the case. We also had to go to the extent of convincing our debtors management or the people who are sales representatives that if we have to pay for something, the creditors had to be paid. Would we pay that liability to the SSE if that is not booked or it is not documented properly in our books? Now that confusion was not sufficient. Now this year they changed the entire scheme that now purchases is going to be subject matter of. So if I'm making a payment for purchases, whether on cash basis or on the basis of booking the liability, whichever is earlier, at that stage TDS has to be done. Again, the cutoff date is from 1st July 2020. So what happens to transactions before that, the total turnover before that, how it will be interpreted after that, all those challenges are there. Now the same transaction may have suffered already a tax is going to suffer a tax on the sales, then whether the purchases, which is the counterpart of the other side, he is supposed to deduct tax at source. We had already the circular 720, which I need to recall for all of us. I will come back to this slide a little later. So section 194Q has been inserted for TDS at the rate of 0.1% on purchases exceeding rupees 50 lakhs from one party where my total turnover of purchases is exceeding rupees 10 crores at the time of purchase or credit to the account of the payee. Not applicable where 206C1H is applicable. Now, where the seller has not provided his PAN, the TDS rate instead of 0.1% goes up to the extent of 5%. Now, this compliance, to what extent is going to be practical, it is going to be feasible, whether it is really in the term of ease of doing business. And once this tax is deducted and paid to the government, getting the credit, therefore, we all know what challenges we are already facing. So what the government has done is that whole football of the tax collection, it is going to get by widening all these avenues and seeing that the goalpost has been made bigger for the collection part of it. How much is to be given back, how the credits will flow back, whether they will flow back or not, has always been a question. It will continue to be a question. This is something that we really need to look at. Can we then say that the rates of taxes or the collection of taxes by the government is going to remain on the same level as it was last year and the rates have not been changed? According to me, this is a white lie and a window dressing done by the finance minister to the public at large, that it is going to collect much more tax by the people themselves. You and I will have to ensure that we are complying with these provisions, irrespective of whether it is our tax or the tax of the other person to whom we are paying the income. We are going to be a part of it. And if we don't comply, we already have provisions of 40A 1A for uh, interest under 201, 201 1A, 220, 200, 271 capital C. All of us, them facing us, already are waiting over there. Then, of course, prosecution is there. So this approach of the department of keeping on increasing the areas on which TDS has to be done, compelling compliance, to what extent it is going to be welcome, to what extent we have to understand it correctly, interpret it correctly, and see to it that we are safe or our compliance is ensured, is a challenge by itself. 206 AA, we all know, is for paying a higher rate of tax if the PAN number has not been provided. For 194Q, this is going to be restricted to 5% instead of non-PAN holders instead of 1.1%. This also has been provided. So each and every clause that is introduced, the government is only seeing, the department is only ensuring that the collection of tax is at the maximum, irrespective of whether it has to be paid back or not, whether the credit has to be passed on. We did discuss in detail the provisions of 43B and Provident Fund deposits. If they are delayed, what is the impact thereof? 3615A, as I said, is already the deduction would be allowed only in case deposit is made in time under the relevant act. So you're trying to enforce the compliance with another act by provisions in the income tax act. To what extent this is justified, whether it should be upheld, whether it should be enforced or not, is a question by itself. 43B also, as I said earlier, not only employer's contribution but employee's contribution. So if the employer fails to deposit the employee's contribution in a timely manner as per the relevant act, same shall not be allowed as a deduction in any year, even if such contributions are deposited subsequently. This amendment will take effect from 1st April 21 and accordingly apply from assessment year 21-22 onwards. When it applies from assessment year 21-22 onwards, all the delays that have happened since 1st April 20 till now also get covered. Therefore, I have no manner in which I can rectify an error that I have made or rely on a judgment that was in my favor so far to say that even a minor delay or a reasonable cause of a delay should be pardoned or condoned or not faced with a consequence of higher tax payment. So genuine tax, a genuine expenditure which has entered my P&L account will be disallowed only for a small delay for whatever genuine reason it may have occurred. Slum sale definition. We had a decision of the Bombay High Court, which was the SLP for which against in the Supreme Court also has been dismissed. But the manner in which this is sought to be enforced is something that we need to look at. Slum sale now, exchange of undertakings. So slum sale exchange, if there were shares issued or if there was an undertaking that was overtaken by the person who has departed, who has given away an undertaking. So I had taken a fertilizer unit in exchange of a chemical plant that I had given. Valuations of both done. The books of account entries were both entered into. The slum sale was very clearly defined in that case whether I could do away with any tax liability on the slum sale. Now provided that, but now henceforth that is not going to be allowed. Exchange either of undertaking or the settlement of the slum sale proceeds being settled by way of issue of shares instead of cash or bank transactions. That is sought to be plugged, and Bombay High Court decision is overruled. Also facilitating PSUs to transfer lock, stock and barrel is sought to be done through the amendment of the slum sale definition. How it will be actually manifested will have to be seen. 45.4. I talked about it initially. Now we need to look at, we know at the time of a partner departing from the firm, whether by way of dissolution or retirement or reconstitution. Each of these terms, again, how they will be defined and how they will be looked at has to be seen. Where a partner is receiving the capital asset at the time of dissolution or reconstitution, which represents the balance in his capital account. The profits or gains arising from such receipt shall be taxable as capital gains in the hands of the firm and not in the hands of the partner in the previous year in which such capital asset was received by the specified person. This is something which beats my logic to a great extent. How it should be taxed in the hands of the firm. A little explanation was given to me, and I could appreciate it only by the fact, especially if there are revaluations done before the reconstitution or dissolution is done, by which the capital account of the partner is increased. So there were decisions to the effect that at the time of dissolution or exit, what the partner is withdrawing is only what is there in his capital account, and therefore that cannot be subjected to capital gains. If that cannot be subject to capital gains, no doubt, what is sought to be plugged now is that revaluation or that manner in which you have increased the capital account for the partner to withdraw at the time of his exit from the partnership firm, that has created an increase in the value in the hands of the firm, and that increase in value is sought to be taxed by section 45.4, the manner in which it has been designed and drafted for the purpose of section 45.4. A new subsection 45.4a is also inserted, which provides that where a partner or member receives money or any other asset at the time of dissolution, which represents the balance in his capital account, the profits or gains arising from such receipt shall be taxable as capital gains in the hands of the firm, BOI, or in the previous year in which such capital asset was received by the specified person. A similar provision as to the earlier one, but now here it is talking about the receiving the actual money. Previously, it was receiving only his capital account, whatever it was. So the cost of acquisition shall be determined as per the manner prescribed in the provisions of the Act, and balance in the capital account is to be calculated considering any increase due to the revaluation of any asset, including the self-generated goodwill or by self-generated asset. The term self-generated goodwill and self-generated asset has been defined to mean the goodwill or asset, as the case may be, which has been acquired without incurring any cost for the purchase or has been generated during the course of business or profession. So when I go in for a revaluation on the basis of a valuation report of an existing asset, and that increase in value is being transferred to the capital account, and that is sought to be taken away by the partner who is leaving and going away, he is going to get the benefit thereof, but the capital gains thereon will be taxed in the hands of the firm. This is a very important provision which needs to be reviewed. And according to me, if at all, the tax should have been in the hands of the partner and not in the hands of the firm. But the appreciation in the value of the asset definitely is being looked at in the hands of the firm. And therefore, both these provisions need to be re-looked at before they are actually translated into law, and how they will manifest themselves has to be seen. Goodwill, as we discussed initially, which is not going to be eligible for depreciation under section 32. The concept of block of assets itself is going to, has taken out of its purview. Section 211 is taken away for it takes out of its purview the concept of goodwill. Section 32 also is amended to say that there will be no depreciation. All other intangible assets will continue. Technical know-how, trademarks, all those will continue. But goodwill per se will not. And sometimes there are transactions where these intangible assets partake or have been booked in the books of accounts already as part of goodwill. Also, the assets to which goodwill depreciation has been allowed earlier. Now, henceforth, from 1st April 21 onwards, it will not be allowed. We had that same concept on the basis of which we had taken over certain industrial units and the valuation of assets was done. The price that we paid for those units that we had undertaken were at much higher than the book value of the assets that are taken, and that difference was booked as goodwill. We had claimed already depreciation on that goodwill in assessment year 2021, but from 21-22 onwards, we will not be allowed on the written down value. So if I booked already 100 rupees, I've paid 25, I have taken the benefit of 25 rupees as depreciation on goodwill in the year 2021. But on 75, I will not get the depreciation in the next year. This is what the new provisions say. This has been strongly contested because the basis on which the transactions have taken place, all the forecasts and the financial implications of all those transactions, which have already gone through and partly depreciation has been allowed. In that case, whether having entered the block of assets of intangible assets, can that item be excluded now as a specific asset on which depreciation will not be allowed, is a question which the court will have to be decided. Will have to decide and see whether the concept of block of assets under 32 and 211 can that be disturbed to that extent. Is going to be an issue. I talked about IFC, International Financial Services Centers and Units. There are as many as 9 sections which are undergoing a change. These host of additional tax reforms for units located in IFC units clearly indicate that the intention of the government is to support the IFSC. The budget also proposes that the government would support the development of world-class fintech hub at Gift City IFC in the journey to make this global financial hub. So, as many as 9 sections, some of them having sunset clauses. Now, some of them have been extended up to 31st March 24. We shall discuss all of them in detail as and when we have a session only on IFSC, because time permitting, we could not have discussed in detail. Of course, some commentators have discussed in detail. Those who are already dealing with IFSCs, I plead limitation of my experience on this front, and therefore I am not discussing more in detail. I've listed down the sections which are undergoing a change and which can be dealt with at a later date. Incentives for affordable housing, Section 80IB. Currently, 100% of the profits and gains derived from housing projects are tax deductible, 80IB. With effect from 21-22, the rental housing project also is going to be eligible for the said exemption. The outer time limit, which was otherwise 31st March 21, is now sought to be extended to 31st March 22. Similarly, we had the section since 1/4/2019 for individuals who would take up a new house for a loan which is sanctioned up to rupees 45 lakhs and they did not have any other house. Amount of deduction under this clause 80AA was 1,50,000, which was for houses purchased before 31st March 21, is now being extended to 31st March 22. This is to give the housing sector a fillip and for the low turnover that was experienced during the COVID period. Therefore, this time is extended. I'm not sure whether it will suffice, but definitely this is a step in that direction. Then we had startups. 80IC is the provision which allowed deduction for profits earned by new startups having a turnover of up to 100 crores incorporated between 1/4/16 to 31st March 21. The deduction was allowed for 3 consecutive years out of 10 years. Which 3 consecutive years could have been decided by the startup depending on the fixed asset capex that it could have done and how much is benefit is undergoing in depreciation and how much is resulting into profits which would be taxable, that could be decided by the entrepreneur himself, and accordingly the benefits could have been taken under Section 1080 IAC for 3 consecutive years out of 10 years. That date has been extended from 31st March 21 to 31st March 22. Equalization levy, another controversial provision which had been brought originally 3 years back. May I have to attach to my power? There seems to be a power fluctuation. I'll just check that out. To switch the power of the computer to the inverter, otherwise I may run out of power. So equalization levy clarifications on a great extent have been sought to be made, but further clarifications are required. It is clarified that tax on royalty, FTS, and equalization levy are mutually exclusive with effect from 1st April 2020. So where royalty and fees for technical services have already suffered TDS under 194J, they would not be suffering equalization levy, because equalization levy income in the hands of the non-resident is exempt under Section 1050. Therefore, it cannot be said that you would have a TDS on the one hand under 194J and there would be an exemption under 1050, and therefore those two are sought to be made absolute mutually exclusive. The scope of online goods, sale of goods, and online provision of services would include instances where one or more of the following activities are carried out online. Here again, a lot of interpretational issues which we are already facing are going to be faced. Whether there is an acceptance of an offer for sale, whether that would be a service or that would be an activity which would already suffer or would be considered an online sale of goods or an online provision of service which would be suffering equalization levy instead of 194J would be a question by itself. Placing of an order of acceptance on purchase order would be another area in which there would be a dispute. Payment of consideration for the services provided, whether or not they would be falling within the provisions of, now we are going to have 194Q, and whether that transaction would fall as qualifying for equalization levy, where there's an electronic mode that has been satisfied or an online transaction that has taken place. That would be a question by itself. Lots of disputes coming up for 194Q, and also coupled with TCS, TDS, and now equalization levy. Supply of goods or provisions of services, partly or wholly, whether to what extent they would be qualifying for which one. Consideration for the purpose of levy under of equalization levy, clarified to include value of goods or services regardless of the ownership or facilitation by the e-commerce operator. These amendments are proposed to be again taken up from 21-22, but are going to be a phase matter of lots of litigation and challenge and interpretation issues, except if some clarifications come, which will be in our interest. The time limits for assessments are being reduced. Time limit for 143(1) would be 9 months from the end of the financial year in which the return is filed. As far as issue of the notice under 143(2) is concerned, it would be 3 months from the end of the financial year in which the return is furnished. So what we had till September now will be reduced to June. So once the end of the assessment year in which the return has been filed for assessment year 21-22, by June 21, we will be receiving the notices under 143(2). So the time limit for passing of the assessment order, this is the most important, for 143(3) and 144, 9 months from the end of the assessment year in which the income was first assessable. Therefore, now what is going to happen is, in March 22, we will have as many as 3 assessment years which will be subject matter of completion of assessments. Time barring would be applied in that year. 1920 would be completed before 31st March 22. Same way 2021 would be completed, and 21-22 will have to be completed before 31st March 2022. This is the time limit which we have to be faced. The number of assessments definitely is going to fall. There is no doubt with electronic and faceless assessments. Only faceless assessment, the problem that has been faced by many SSCs is going to be the timeline within which they have to submit the details. I remember we received the notice for assessment year 1890, which ran into 16 pages, and as many as 35 different items were called for, including production of books of accounts in an electronic mode within the 10 MB that has been provided. I was wondering how my books of accounts of a huge corporation, which is having a sales turnover of 10,000 crores, can be fitted into a 10 MB size, and that too within 10 days of receiving the notice. Further, what was required was to file the sales register and the purchase register in a given columnar format that has been provided in the notice. Whether again such a provision is going to be practical for finishing the assessments in the time within which 9 months from the end of the assessment year in which the income was first accessible. This is going to be a challenge. How it will be achieved has to be seen. We have already made representations to this. Times have no doubt been extended. From the first time that we received the notice, we were provided 10 days. We made a representation, it was extended by another 15 days. And after 15 days, again, we made a representation, time has been extended. But at the same time, the challenges to be faced, I feel, are going to be very high, on the basis of which compliance will be done for faceless assessments. The experience of faceless appeals was comparatively less troublesome, and we could upload the submissions in a much detailed and easier manner. At the same time, the space constraints and the software and network issues that are going to be faced is going to be a challenge which I think over a period of time will get settled. Faceless ITAT scheme. Government has already launched, as we said, the assessments and the appeals in a faceless manner. The tribunal is trying to settle down with a faceless of filing of appeals, which has not yet commenced, which we have not yet been able to see, but that should be happening soon. What is sought to be further framed is a faceless ITAT hearing, where the proceedings will largely be faceless. I will also not know the members whom I am addressing. At the same time, if a video conferencing is required, that would be made available on application or on the request of the SSC in order to make the submissions before the bench. Today also, for the matter, today morning I had a hearing before the virtual hearing before the tribunal. We could definitely have, and we did file a paper book much in advance so that the hearing could take place. We did have the hearing online, and the bench went on up to 2 o'clock to complete the total number of the appeals that it had already planned to go ahead with. So normal time of 1:30 practically gets extended, except if you are ready for adjournments and you want to take up the hearing at some other time. The experience at the tribunal has been very good as far as appeals before the tribunal are concerned. But when it becomes faceless, what the position will be has to be seen. And if it is faceless, that means the submissions only will be made in electronic mode, and it will be irrespective of who has made the representation. And therefore, perhaps just as we do not know who is listening to us, perhaps we may have to settle with a position who is representing us may not be as important, as long as the points have been put across and the technicalities on the basis of which we are seeking relief have been put across. How exactly the faceless tribunal scheme is going to be actually formulated and how it comes across has to be seen, and the quality of the judgments. But being the last fact-finding authority, definitely there's going to be a hue and cry whether a faceless assessment or a faceless appeal can be held good as to provide you an opportunity for a fair hearing, and all the points are appreciated. Only time will tell us, but that is the era we have come to. We already discussed the audit limit of 44 AB. One important aspect which we have not discussed is 44 AD. I remember when I was talking on tax audit on an earlier occasion, one of the questions that was raised was whether the presumptive tax for professionals can be applied to all SSEs, because the wording read in respect of a profession carried on by the SSE. SSE was not specified here hitherto, but now from assessment year 21-22, it is being specified. And the reason is obvious, because in a presumptive tax era, we were seeing that whatever conditions if they are satisfied, in this present case, if the total receipts are less than 50 lakhs, it is presumed that the taxable income earned would be 50% thereof, and therefore, if the tax is paid at 50% of the gross receipts and no books of accounts were required to be maintained, that would be sufficient compliance with the tax liability, whether chartered accountant firms, advocates firms, doctors, professionals. For them, this was a very advisable and suggested scheme, and it was also being fruitful. However, the question also came up where books of accounts are not required to be maintained under LLP Act and under the Companies Act, whether an LLP or a company could also go in for the presumptive tax if other conditions were being satisfied. Till now, there was no restriction, but the present amendment to Section 44 ADA says that yes, we from assessment year 21-22, LLPs and corporates will not be eligible to opt for 44 ADA. These were some of the provisions I thought were absolutely necessary. Yes, a very important provision, and this is going to cause havoc. We already had this provision earlier, but now it is being expanded further. That is Section 281B. This is a section which will provide for cases where on assessment or reassessment, the assessing officer may provisionally attach the property of the assessee if necessary in order to protect the interest of the revenue. Such provisional attachment is valid for a period of 6 months, and the powers of this section can be exercised by the assessing officer. The Section 271 capital AAD of the Act was inserted in the Finance Act 20 to impose a penalty on a person or a person who causes such person to make a false entry or omit an entry from his books of accounts, particularly for those fake sales transactions and those transactions. This was an anti-abuse provision that was inserted. Now the assessing officer has been empowered under 281 to 81B to safeguard the recovery from by attaching the account of the assessee under 281B, where it exceeds 2 crores of rupees. So if the penalty exceeds penalty under 271 AAD is likely to exceed 2 crore rupees, in that case 281B can be invoked by the assessing officer and he can attach the bank account or see to it that it is ensured for the department. So the goalpost has been widened. The assessing officer has only to kick the ball in that widened goalpost to see to it that the recovery is made. This is what has been ordained for us, and we need to look at. These are some of the provisions I thought we should discuss in detail. There are many other provisions which we may have to discuss as we go along and as we see that we are faced with challenges. If there is time and we need to discuss any particular issue, I could take up questions from the floor. Can I stop sharing so that perhaps I could interact with the audience in a better manner? I was really facing, frankly speaking, I was facing tremendous hardship to look at a screen which is only showing what I am presenting and not even know what the reactions are whenever we have been discussing in study circles. Otherwise, it has been a cross talk and we have been able to discuss in detail. However, now that the time is there, if there are questions, I would like to take up any questions, or if I am ready to solve them. I'm not sure whether I'm ready enough to solve all the questions, but some of the provisions definitely we'll be able to discuss, and only experience will tell us as to what further we have in store for us.
So, thank you, sir. First question was, there's only one question in the Q&A which is asked right now. What is the period of expenditure under LTC cash scheme?
The period is from 12th of October 2020 to 31st of March 2021. The expenditure has to be done within that much period.
Yeah. Members, if you have any other questions, please raise the hand using the software. I'll enable the audio so that you can ask the questions directly. Rajiv sir, please go ahead.
Umaji has to come up with some question which I'm sure it will be difficult to answer.
I'm
You'll have to unmute her.
yeah, I'm unmuting her. Go ahead, Uma madam.
Yeah, can you hear me?
Yes.
So, Atulji, as usual, your presentation is a very, very logical presentation. So very easy to understand and clear. So not a very difficult question, but I always have this problem in my mind, even before. When we have 50% or 7% or 8% and they say no books required, does that mean that we have to spend technically the 50% to show that we have because still they have the power to open the our assessments, and does it mean that we cannot allow them to purchase any assets? Because usually you find that there could be opening balances from which they have saved they have paid for anything, or many times in case of professionals really they don't have that 50% expenditure, but they say yes, if we are entitled, why not, and so they go for it. So I always have
I
this
think
in
a presumptive taxes, presumptive provisions are giving you a facility. It's not necessary you have to opt for it. If you have tax, if you think your profits are higher than 50%, you can also show higher profits. As the question was definitely put to me earlier, that if I have higher profits, then whether or not I may not opt for 44 ADA, I may maintain my books of accounts, get them audited, file it, and show even a higher income or a lower income. If I'm showing 50%, no questions will be asked, except if I'll have to justify that my gross receipts are what they are. Now, how will you justify that is going to be a challenge for you, especially if you are going to receive anything in cash. Otherwise, perhaps if you have got...
problem. Sorry.
Yeah, please.
Clients don't want to pay more than 50%. This is बाकी सबके tax advisor बोल रहे हैं. But I always have this feeling that if you are want to make any investment in future, technically, how will you build up that capital? Just because you are saving tax. Am I right when I say this?
And you're absolutely right. If your actual capital is much higher than, and what has been built up is much higher than a return of 50% on your gross receipts, you are absolutely justified in maintaining your books of accounts, getting them audited, and filing them accordingly.
No, I'm not talking of being justified, being required from your own advantage. I always have this difficulty. So today, when presumptive taxation is gaining more and more importance, and when clients are being aware of presumptive taxation, I had, and now that we had time also, a little time, so I thought I will take your guidance in this regard, because I feel
I have always held that if the presumptive tax is not showing the correct picture, I am free to go ahead and show the correct picture either by way of a lower return on my turnover, or a higher return on my turnover. And if I'm doing that, I need to go in for an audit and file my return accordingly.
Thank you so much. Very nice of you. Very nice presentation.
Yes, Ravi, I'm waiting for your question.
1 second. I'm enabling his mic.
I think we need to look at the manner in which we are having this virtual conferences, because other study circles, though it's not a webinar and it is that is what the distinction was being explained. I think the interaction, even if it is not during the lecture, it has a face-to-face reaction as well as the chat box and those things come out much easier.
Agreed, sir. But institute guidelines don't allow.
Why others are doing it already?
They are doing it, but institute.
Even institute programs themselves are having it. We have a chat box, we have raising of hands, we can see each other, what is going on. I've had so many of the lectures over there. I think there is some misunderstanding. I'm sorry. I don't think the institute says you cannot have that facility.
I think now we can have physical meeting also. Institute did
physical
have
meeting. Definitely, physical meetings are also possible. Mr. Gautam Doshi did. Unfortunately, there were only 28 participants in the hall, but he did have a physical virtual meeting. But then also we could raise our hands, we could shoot our questions, we could do chat box. Everything was possible. I talked at Khas Study Circle. There also we had the same facilities available. I talked at JB Nagar. We had the same facilities available. I'm a little surprised as to why Prabhadeli Study Circle has this sort of a non-interaction facility for a virtual meeting. I think we need to re-examine what.
Next time we'll have a physical meeting with
even if supposing for any reason physical meetings may or may not be this thing, but virtual meetings can be had in a different format. That's exactly what I'm trying to say.
Atul, I had only one question. The limit for tax audit is raised from 1 crore to 1 to 10.
Yes.
Is the limit for professionals also increased, or it is same?
No, it is the same.
Okay.
So far, it is the same.
Okay. So I hope to meet you in person someday.
Most welcome. I'll also see that I can come there sometime. Nothing stops. I think now the movements have started to a great extent.
Yes. Chalo, take care.
I hope vaccination makes it better still.
Yeah, should be.
Chalo.
Thank you.
Sanjeev sir had asked a question in the question box. Is LIC policy with 12% GST allowed for LTC benefit?
No, I don't think so. These are supposed to be white collar goods they are talking about. White collar goods. I don't think LIC policy qualifies for that. I will have to check up, but I doubt. We in particular were told, especially in the Tata group, that go to Chroma and buy what you like. Though I had already superannuated by the time this had come. And I was the one who had objected that without the rules coming in place or amendments coming in place, we should not extend it. I'm sure there would be many more issues which are still to be debated, and we are waiting for clarifications.
Ravi sir, go ahead.
His hand is raised, but I don't know whether he has a question. Can you all see me? I can't see anybody.
Yes, we can see you.
It is a little.
Now?
Hello, Ravi sir, you can go ahead.
No, I had asked this question. Okay, for professionals, they have discriminated by not increasing the limit.
Raise a noise. We have to.
So चक्का जाम कहाँ करने का है बोलो?
दिल्ली के बाहर आउटस्कर्ट्स पे.
दिल्ली के बाहर वो बहुत कॉस्टली पड़ेगा. इधर सिद्धिविनायक के सामने करते हैं तो इफेक्ट ज्यादा होगा.
Perhaps he may hear us. Whether the finance minister hears us or not, he may hear us somehow. Yes, Ganpati ji, your hand is raised. I can see the pop-up. I can't see the hand raised. I can't see you.
His question is, are the reduction in TDS rates announced last year through a press note backed by a notification?
So far, no. That will stand good only up to 31st March. After that, again, they are going to change back to the old rates. Those things are also promised, but they have never come. I was wondering whether issuance of press notes is going to be the norm of the day, and you don't need the act, you don't need the rules, you don't need the notification, you don't need the circulars. It will be only press notes that will govern the act.
Anyways, official Gazette of India is Twitter now. Any members want to ask any other questions?
Excuse me for 2 minutes. I'll have to check up on my inverter again because I think there is a problem.
Yeah, sure.
Yes, did I miss a question?
There are no
Is
questions.
Mr. Dilip Gondale not participating today?
He is there. He is attending the lecture, but
Dilip bhai, I was expecting a question on your 1023C limits being raised from 1 crore to 5 crore.
his
Yes.
mic is unfortunately not there. It is showing error in using microphone on this side.
Oh, so he's not getting unmuted, is it?
Yeah, might be he must have not given the permission.
Sanjeev Patankar ji. Sanjeev Patankar ji.
Chat box. For disallowance of interest on PPF, each fund has to be considered separately, or PPF and PPF will be aggregated for disallowance, particularly in case of salaried employees.
Yes, that is as I said, that both the sections giving the exemption themselves are two different sections, 1011 and 1012. So basically PPF should not be clubbed according to me. And there's no, even in the explanation provided, though the wordings are exactly the same for each of them, since they're two separate sections, according to me, the exemption would operate independently. Number one. Number two, in PPF, as it is, I cannot put more than 2,50,000, 1,50,000. Therefore, crossing the limit there per se is not going to be possible. But yes, combination of what is being deposited by the employee, what qualifies under 1012 and what qualifies under 1011, should they be cumulative or not? As the wordings are right now, the effect is not there that it should be cumulative. At the same time, looking at the holistic picture, where even an employee under 1012 is getting a benefit of being able to invest up to 88% of his basic as a voluntary provident fund. In that case, definitely it should apply cumulatively. What you are trying to say, I can appreciate fully that it should apply cumulatively. But there are cases where people invest into PPF, but they don't claim the benefits at all otherwise. Under ATC in particular, they don't claim the benefits because the regular PF is enough for them. They cross the limit of ATC as it is by themselves. They may only treat it as an investment. If I have treated it as an investment and not tried to take any tax benefit therein, whether there should be an exclusion or not. Today morning, Bombay Chamber, we were arguing this, and definitely we are going to make it a part of our presentation, that if only the investment into the PPF account or the Provident Fund account has been taken as any benefit has been taken, tax benefit, only then it should be taxed, not otherwise.
Rajiv sir had pointed out saying that there is a clarification that PPF will not be PPF will not.
Where is that clarification? Where is that clarification?
I don't know. You were saying in the newspaper.
No, I know there is a one opinion, set of opinions going on the same lines. But if you see, there is also yesterday, I think Khitan and Company, there was somebody who has specifically said that they are operating under two separate sections for 80, 10, 11 and 10, 12. And neither of them are referring to the other at the time of giving this benefit or withdrawing. And therefore, they will operate independently. In the first year, there should not be any problem. Second, third year onwards, when there will be accumulation of what, or the interest on interest will start arising, then the question may arise as to how, if it goes strictly by as it is being laid out right now. I put only into PPF 1,50,000, next year again 150, next year into 150. Now the interest also the 3 years, finally when it gets accumulated, and then if I cross 2,50,000, then what happens? हाँ गजरिया जी, आई वॉज वेटिंग। एनएच ने क्वेश्चन कैसे नहीं पूछा? यू अनम्यूट करो पहले आप खुद को। आई कांट हियर यू।
I don't see him in the.
There is a pop-up. There is a pop-up.
There was a pop-up. I enabled his mic, but I think he.
Seriously, we have to look at. Seriously, we have to look at. If we have to use this for study circle meetings, I think this. This particular tool is not working right, and other study circles are using.
Yes, of course. We'll look into it.
What is permitted and what is not permitted, and how we can best have an interaction.
And any other.
COVID has really taught me to speak without an interaction, but then I don't enjoy it. Whatever limited interactions we are having at other study circles, even that is not there in this particular study circle. Hand is still raised, Naveen Chandra Gajaria ji. Mic cannot be. Are you with Mr. Dilip Gondalia and his mic is not working, so your mic is not working? Sanjay, are you there?
He's sick today.
He's sick?
Yeah.
The birthday celebrations extended. नीलेश चार्जर है क्या? नहीं. Even list of participants I cannot see, is it?
I don't know. You should be able to. It is about start sharing.
I can't. That is what I'm saying. I can see nothing at all. Most surprising part is that. Right now, only my camera is showing me. That's all.
Manoj sir,
go to VCM. When I go to VCM, perhaps there also I'm not seeing anybody else. Manoj Kurau ji, boliye ji.
Can you hear me, sir?
Yes, now I can hear you.
Sir, excellent presentation as usual. Really appreciate it. And only thing I wanted to ask, sir, this amendment in section 45(4), I think it's going to badly impact everyone.
Very bad, very badly. I mean, it is lots of schemes that were being thought of or were being this thing. This is going to be very bad. And factoring in the tax on the firm is going to be a large issue. Very large issue. I think BCA should be taking that up more seriously, because the Bombay Chamber, normally we have corporates and they are less affected by 45. So there wasn't much of a discussion there on 45(4) in particular. But Bombay Chartered Accountants Society, even our institute itself, Gautam Bhai did cover it. Yes, Manoj ji. Except 45.4, anything else?
No, sir. Thank you so much.
क्या गजरिया जी क्या हो गया आपका माइक चालू हुआ कि नहीं हुआ?
I think Acharya ji has left.
Oh. Yes, मेरे फोन पे मिस कॉल्स आ रहे हैं अभी. Those who could not ask questions there, they are going to ask me here direct. हेलो. हाँ जी. हाँ जी. हाँ. हाँ जी. एक अभी कॉन्फ्रेंस चालू है मेरा, वेबकास्ट चालू है. कितने बजे आओगे आप? हाँ. विला ग्रैंड. नहीं एबीसी कुछ भी नहीं है. आपको एकदम सीधा सर्कल से आना पड़ेगा. आगे वेलनेस का स्टोर आएगा, वहाँ से राइट ले लीजिएगा और अंदर राइट साइड दो बार राइट लेंगे तब जाके विला ग्रैंड मिलेगा. ओके. श्योर.
I don't think anybody has any questions. Shall we end it?
Yes, we can.
Yeah. Thank you so much, sir, for today's lecture. I really liked your.
I have missed quite a few people today. Sanjay, of course. Dilip bhai was not there to shoot questions at me, or he could not be heard.
We surely missed the physical format, but
try to change this virtual format
we'll
also. Virtual format also try to change it a little. Perhaps that may help.
Yeah. Because virtually problem is ki this webinar module is not very friendly. I know that, but I'll share the guide.
Zoom meetings. I am told I've been allowed and I've been participating.
Zoom. Actually, we originally had a Zoom subscription.
At that time, I think the entry and exits were not being monitored well.
Yes.
And that is why they had said Zoom is not to be used.
No. Zoom entry and exit was perfect. Problem is the attendance feature, which institute requires us to have a log and all. So most softwares don't comply on that front. And this Zoho was a last.
How come the others are using it? That's what I'm wondering.
I don't know, but nobody's bothering to check. Institute is actually not bothering to check, so they are not having a problem. But
Institute itself also, when we are having, there are some seminars I've attended at the institute itself. They are having. We can see the participants. We can log in also. They are having everything.
Yeah, that must be true. But I'm just saying that the guidelines which were shared, we are trying to follow them. I know that meeting mode is more convenient. It is also cheaper and it is also easier to organize. This webinar module is very irritating to organize. As an organizer, I would be more than happy to have it in meeting mode. Right. But just to follow the guidelines and to keep ourselves compliant, and we are having this in webinar module, nothing else. So if the members agree, I can have it in meeting mode also. It's not a big thing for me. It's actually easier.
Fair enough.
Yeah.
Thank you very much. Thank you everybody for a patient hearing. Of course, little more time and little more things could be discussed in more detail.
Yeah.
I had 2 tribunals during this week after the budget, so I could not devote enough time to my preparation. To be really honest, I would have liked to do a little more.
Atul.
Yes.
Can you share the slides?
Yeah. The presentation will be shared. I'll share the presentation.
Yeah, definitely.
And Mir,
तू
कर रे कंडक्ट मीटिंग मोड मध्ये काय होतं का बघू नंतर आपण.
ठीक आहे.
पुढचं पुढे
आपण करू मीटिंग मोड मध्ये.
ओके.
Thank you. Thanks, Ravi.
Bye. Good night.
Bye.
Good night.